Okay, good evening, guys. If we got started as always, let's do the customary instant poll. Let's check if we can hit the volume correctly. So on your screens now, let me know if the sound is perfect, too loud or too low. My standard settings, so it should be fine for you guys. Okay, quick off the mark there, guys. Cheers. Thank you very much. Okay, majority of people are saying perfect. So what I want to talk about tonight is all about gap trading. Now, gaps appear less often than they did in the markets maybe 10 years ago, but they still do appear in the charts, especially when you look at maybe Sunday night opens and kind of trading after big news events across the globe. So they're definitely something to keep an eye on. And most chartists don't like gaps. Obviously, gaps are just as they sound. They're a gap in the data, a gap in the prices. So they often identify and signify something significant has happened. I guess it's our job as traders to figure out why that gap has happened and how we can capitalize and trade from it. Now, before I start, as always, the risk warning: whether spread betting or safety trading carry a high level of risk or capital, resulting in losses that exceed your initial deposit. It's not suitable for everyone, so please ensure that you fully understand the risks involved. Now, the information comments provided here under no circumstances and offers a station to invest. Nothing you're interested in construed investment advice. The information is provided to be accurate. The data is produced. Educational only. The content of the webinar is personal opinion of the moderator at knowingtrade.com. The content does not constitute financial investment or tax advice. Knowingtrade.com does not accept any liability for the content comments made during this session. So what is gap trading? I mean, there's very little that's new in trading, and the gap trading has been around for a long time. Well, you've had technical analysis. You always find somewhere down the line there's a gap in the data. So the more and more people trade the markets, the more exposed we are. These little or these lesser nuances that happen in charts become more jumped upon by traders. There are only two types of gaps in my experience, the most common being due to fundamental news. So something new has happened in the market and there's been a price gap between the bid and the offer, and there's something therefore significantly represented by the gap in data due to that new piece of news. Then you see other technical type gaps where you've seen quick price action and quick market movement, and they're a little less easy to identify in some respects, and they're generally a lot smaller than fundamental gaps. I guess understanding the markets, understanding how markets chart, how products chart, what the market's doing with that 80-20 relationship between the fundamental and technical data is key to these things. A gap is, anyone can spot a gap. It's very, very easy to see. It's what you then do with that gap that, is quite difficult for traders. I guess there are five main types of gap that we're going to look at today. And the higher up the time frame you go, the more significant a gap will be. You might see very small gaps, relatively frequently on a minute chart or even tick data. But when you go back to the bigger time frame charts, your hourlies, maybe your dailies, weeklies, monthlies, then gaps are much more significant. So fundamental gaps are either driven by news, which is to do with growth or inflation. They're either a reversal style gap or continuation style gap. So again, there's only two main types of gaps, fundamental or technical, but there's different types of gap that we're trying to identify how they behave, should I say. Then the technical type gaps, appear to show on the charts as trading activity. So we have a full gap, long short, or a partial gap, long short. So news is one of the main reasons for gaps to appear in charts. Now, why is this? Well, if you read the Dow theory or you listen to the efficient market hypothesis, anything to do with trading, the markets are trading between a bid and an offer, a certain price, because all the information is known. So that being said, if any new news comes into the equation, be this, I don't know, any kind of comment from a central banker, Janet Yellen, for instance, to do with interest rates, or unexpected changes to growth, to inflation, anything to do with maybe a terror attack, or anything that shifts the popular, or where the market is meeting, or the populist kind of idea of where a market is finding value and for what reasons. Anything to change that will mean there will be a shift in the equilibrium. Okay, now over the years there's been a lot of different information, in all respects, and they don't always cause a gap. Generally, what you'll see is an initial move. Okay, the market will move very quickly up or down because that's generally people getting out of positions rather than in. And then you'll see the gap happen after the news is known, and that kind of speeds up the kind of trading. So it's especially if you see something major, like again, like a terrorist attack, you will see the markets quickly reverse the direction. So stock markets will come down very quickly, but they won't necessarily gap instantly. Maybe what they'll do is they'll reverse people that are long the stock market, okay, and then people will get out of positions. And as that news filters through to more and more people, then there will be a gap in trading because that momentum comes in. So as I've always said, it's very important to understand that any kind of fundamental news will move the markets, but markets will always move in a technical manner. So markets are absolutely, in my opinion, 80-20. So the 80% always has to be adhered to. So support and resistance in these aspects will be broken and tested, and you might actually see a technical gap which is driven by fundamental information. But again, that gap will still be caused by that underlying new news. So really, it's finding that toss-up really between what is moving the markets and why, and what you're trading, you're basing your trading decisions on. So the main way to identify a good news gap is to know, again, what economic cycle we're in. So we're either in that growth where we're focusing on GDPs, we're focusing on employment figures, all the things that you hear in the news, or inflation. I guess the difficult thing we're in, kind of economic position we're in now, is that we are looking to interest rates, especially from the US. We know that the US, raised their interest rates by a 0.25 percentage point last year, and now the Fed has said that this year at some point we're going to get 4, and then it was 3, and maybe it's 2. So what we're really in now is we're still in an inflationary style of looking at the economics and looking at the figures that are moving the markets, but it's still really based upon that growth. The whole point of Janet Yellen in America saying that we're data dependent is she's looking at growth data to make a call on interest rates, which again, are inflationary. So it's quite a difficult time at the moment to understand from a fundamental perspective what's driving the markets. Because it's almost, in some respects, that good news is bad news is good news. So when we see a good non-farm payroll, okay, so good non-farm payroll should mean more jobs, more people spending, more growth. But then from the other side of it, good news could mean that the Fed are going to then put interest rates up quicker or hike them quicker, because that good news, is what the Fed are looking for. So actually, in the grander scheme of things, a good employment situation could actually be bad, because that means that Janet Yellen's going to move on them interest rates quicker or more aggressively than we thought. So that's good news in actual terms is bad. And that's where it gets really, really complicated, that you can't look at good data, inflation data, or growth data, because it's so dependent on the other side of it. Now, when we're looking at these two main categories, we have to understand what cycle we're in now. Now, we've been in the kind of growth cycle for a long, long time now, probably since the credit crunch. All we've been looking for is to fix that gap, to fix that shortfall in growth. And we're looking at it from all places, looking at it from the USA, we're looking at it from China, looking at it from the Eurozone, looking at it from the UK. And it's very difficult. I think what economists have been very guilty of, especially policymakers, is that maybe, the new norm is just less, that we can't expect old levels of growth that we've seen, that we can't expect interest rates to be normalized and get back to 4, 5, 6%. Maybe the new interest rate we have to deal with is 2%. That's the new norm, because people basically are living their lives on debt. We've got mortgages now being open to people until they're 85 years of age. We've got people that literally are going to be having to throw the keys back to the estate agents if interest rates go up by a 0.25 basis point in the UK. So all these things are very, very, very difficult. So again, when we're looking at the gaps, we have to understand the market conditions as they are and how these things are moving the markets and how the underlying gaps that appear in our charts, what is the underlying reason for that happening. So growth news is anything to do with non-farm payroll. So non-farm payrolls, GDP, trade deficits, earnings, jobless, anything that can be brought back to are more people working than not, are more people spending than not, all these kind of things. And really, if you look at any kind of fundamental news that will move the markets, it's going to come from Mario Draghi, Mark Carney, Janet Yellen, and Jack Lew. So really, we have to think that the US is still the biggest nation from a consuming point. So any news at the US is really what's focused on. So I would say for economic terms, for looking at gaps, for looking at movement, for looking at anything that will shift that efficient market hypothesis will be from Janet Yellen. Now, Mario Draghi is convinced that he's going to sort the Eurozone out. He's talking about, cutting rates even further, helicopter drops. I mean, there has to be a point where, the free money has to end. and really anything Draghi says will only affect the European markets. Mark Carney, very cagey. There's talk about interest rates in the UK maybe not going up till 2019. I cannot see, that being, as I said, there are a lot of people that will be heavily affected by interest rates going up. But Mark Carney's come out and said that we're not in a consumer-driven recovery. Well, if we're not in a consumer-driven recovery, then put interest rates up. Reward savers. Try and normalise the economy. There's no way we can survive responsibly on this, this ability just to borrow your way out of trouble. So really, anything that Janet Yellen says, who's the chairman of the Fed, and Jack Lew, who's the head of the Treasury, that controls the purse strings, these people that say these things to do with GDP, non-farm payroll, and their opinions on what's going to happen to future interest rates are what is moving the markets right now. And it's anyone's guess, to be honest. And it is that. It's anyone's guess because the market can price things in, but the market is known to be wrong. And the forward guidance is given by these speakers is historically, very shaky. These people never come out and say exactly what they think is going to happen. It's always coded. So the news sources, as always, will be the ECB, Bank of England, Fed, and any kind of serious news agency will report these things. So if you're trying to look out what's going to cause a fundamental gap or cause the markets to shift their opinion, then it's going to come on Reuters, Bloomberg, AP, Sky News, and there's no snobbishness about where you get your data from. Back in the day when I was trading, you had your Bloomberg terminal, your Reuters terminal, and that's where the information was. That's where it came from. That's all your news. But with the advance of social media, access that people have to the internet, it's very hard to keep anything a secret. So, for fundamental traders, there's never been a better time because information is everywhere. So I'm looking at growth news. Again, this is an example of a growth gap. So it's something that's actually quite interesting because we're at this point now where the markets are looking, certainly in the UK, to the potential of a Brexit. So Brexit, what is it? It's the UK leaving the European Union. A lot of scaremongering, a lot of the For campaign saying it's going to be another 10 years of uncertainty. And again, that's the key phrase: another 10 years of certainty. Not been any certainty in the last 10 years. So what's another 10 years going to do for the average person? Probably nothing. You're going to be poorer, you're going to have less money in your pocket, blah, 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 blah. There's no stats, there's no figures to back up these things. But this is what is interesting. This is how market news filters through to the markets, how it gains momentum. So this is Scottish votes. We see here, this is the first point where the market picks up that potentially Scotland were actually going to leave, or vote to leave, the UK. And that, brings into the mix here with the pound, a new kind of direction. So when the market gaps initially, it's only a tiny gap. But as the markets move on and we see the market selling down every time it gets to a high point, so the market acting, as resistance all along here, when the market actually gets then a better idea that maybe that there is a strong possibility, even much more than we initially thought, that the market might potentially see a Scotland, voting to leave the UK. We see the pound against the dollar dramatically drop in its in its direction. So again, it's all these things we're looking at. We're looking at for something to happen to give us an indication that what the market's thinking. So when the market gets an idea that potentially something could happen that's bad for the pound, and that's Scotland leaving the UK. So we see a little bit of a movement. But as that momentum grows, and as the market starts to actually take things seriously, so a lot of people didn't think that was going to happen for a long time, the market then picks up momentum. So what we see in the first instance is a small gap of what was going to happen, if that was to come to light, and then a bigger gap as more information is known in the markets. So what you're looking for is that initial identifier, which is the market will move down if Scotland leave the UK. And again, in the second instance, as that news becomes more compounded and comes through to the market through different sources, then further down the line you see an over-exaggerated move because we knew what happened in the past. So that's what the markets are all about, figuring out what happened in the past and using that to predict the future. So very much like the Brexit, the more time we hear polls that yes, the vote yes to leave the European Union to come in, then we see downward pressure in the pound. So if it comes to the decision in June that we do leave the pound, obviously you're going to see weakness in the pound. If we don't, we're going to see strength in the pound to reverse that trend. So what you're looking for, again, is looking at what happened in the past and using it to predict what could happen in the future. So very simple. When you see a gap, take note. It might not be just there and then that the market actually does something with it. It might be further down in the future. And that, again, is putting that fundamental view and these gaps to work. That what's happened in the past can predict the future, but it doesn't mean it's going to necessarily happen there and then. So once we understand the why the market's gapped, and we can build an idea of what the longer term direction of the market could be. So obviously we're looking at the complete or partial reversal continuation of a trend. So in that original idea, we're trading off the back of news that it was more likely than not in that period in time that Scotland would leave the UK. See a small gap, that gets confirmed, compounded, the market moves even more in a downward direction. So what's going to happen after that gap? The gap's either going to continue and make the market move even further as more people are drawn into that trade, or it's going to be discounted and the gap will then close. So there'll be short, medium, long-term traders in the market, and what we're looking for is basically essentially people to be wrong. The more people that are wrong on a short, medium, or long-term view by this news, the bigger we're going to see the reaction. So if it comes out in June that yes, we leave the the European Union, then you'll see short-term traders jump in to sell the pound. We will see people exit the pound for long, maybe longer-term positions, and that will all get compounded because people all along the curve will be right and wrong in their opinion. So again, the bigger the magnitude of the news, and the more it upsets the initial trend, the more the market will move. So how do we trade these news gaps? Well, again, it all goes back to that fundamental movement. We see that shift in the market, but it's actually the technicals that help us trade it. So this move down here, it's a gap. I mean, there's no other way of saying it's a gap in data. The market was going up higher. Okay, it found some resistance here. Some resistance here, and then it is gapped down, and then we found support. So really, once you've seen this big movement in data, it's then figuring out what's going to happen in the future. So we just use our standard trading terms. So things like support and resistance are trend lines. Okay, these are working. This resistance, this support. So what we're trying to do then is maybe do something like a Fibonacci. So we do a Fibonacci of the gap. If the market doesn't get back to a key level like maybe the 50%, which is always something we've looked at time and time again with Fibonacci, from the low to the high of the gap, this is the 50%. So we don't get back to that 50% on the bounce upward, then there's more sellers still than buyers. So what happens? Well, every time we hit highs in the market continues in the gap direction, which is down, and the market then sells off. I mean, pretty simple when you look at it. But what you don't want to do is get caught up in the news. Caught up in the sentiment of the news, should I say. Because when the market is gapped down here, what you don't want to be doing is selling when people are taking profit. What you want to do is find a significant high point in the market and then sell high, as always. What you don't want to do is get to the news late and start selling it as the market takes profit and moves back up. Obviously, easier said than done, but the fact of the matter is, a gap's made. It doesn't get back to the 50%, so 80% of the time is the kind of Fibonacci rule. If it doesn't go on to close the gap or make a new high, it's going to make a new low. So where's the new low? Anywhere down below here. So we see many a time that the market hits what was potentially support, or potentially, I guess, resistance, and it moves down back to the support lines that we draw in the more immediate time frames, and the market continues then to move down. But it's all based upon this initial gap. Market gaps down, doesn't go back up, so what does it have to do? Then it has to go down to make these new lows, and that's what the market does. Okay, so again, figuring out what happened in the past, using that to predict the future. That is how we trade any piece of fundamental data and use it in a technical bias. So what we're looking for in this particular example is that partial reversal, that anything that moves, it doesn't matter what it is, what product it is, what goes up will come down, but it's how it moves. So the market moves down aggressively. It gaps. Simple. So everybody who's long from this position here is caught. So people are getting out all along this curve. Yeah, and people come to the data late, and then they'll have to get out here. So what sends the market up is people in the short term that have sold into that and taken profit, people in the long term that have to get out from long positions by buying the market. So to get out of a short, you have to buy. So the market then does pop up. But then that initial gap reaction is partially closed. We don't get to that key 50% level, which tells us from the high to the low, the market isn't coming in with buyers to close that gap fully. So we see a partial gap still remain. Then the market then gets weaker and then continues to move down and makes the new low below here. Okay, so again, using the past to predict the future. So continuations in gaps. again, is that that idea that the market is gapped in a direction, so it's going to continue to move while that gap is still in play. And that's all the action we see afterwards. So the market moves up, as we say, with people profit taking or people getting out of longer term positions, but the continuation is that that gap is not closed. And as that gap remains in the markets then continue to hit points of resistance and to sell down. So every high point that we see in the charts, these are areas to sell. Okay, and we buy the market back lower. So every time we get high, we sell the market back down. Not to say that you can't buy dips or whatever, but the most logical thing to do when a market's moving down is to figure out a high point in relativity using Elliott wave, using Fibonacci, support resistance, pennants, triangles, trend channels, whatever it is, and you're selling high while that gap remains. Okay, so that is the trend continuing. So break or bounce levels are something I've mentioned, previously, and they just are essentially support and resistance. So what has happened is that markets, when they have moved very quickly, is that the whole view of the market might have changed. If the market gaps down 200-300 ticks in one trading movement, then what was support or resistance might have changed. Because if you've moved 300 ticks, then what was support all of a sudden now might not necessarily be support. It might be there to be broken, and you find the next level of support. So what we're looking for is using support and resistance lines like this to either break or bounce. We know that the trend is down, so instead of getting to these resistance points and bouncing up, the market is looking to bounce back down. Okay, it can't break up, so it bounces back down. This again is a break point instead of a bounce that it was previously. Market moves down. And again, we do see a bounce, but expect it to be broken on the way back down. So you're looking at the break bounce scenario in real time terms, should I say? Because what's happened in the past will happen again in the future. Sorry, screen's just there we go. What's happened in the past will help us predict what's in the future, but with the gap in play, that all of a sudden that technical analysis that we've done, it shifted. Okay, so if the market's moved, 2 or 3 times its daily range in a very short period of time, then what was support or resistance back then might not then be relevant. So what you're looking for is support or resistance might then be break or bounce points. They don't act in the way they would have done in normal market conditions. They're actually working in the opposite way. They're more targets to break than bounce. So again, just to figure out that when you see a gap in the market, generally something big has happened, then it's understanding that something big has happened, the market's changed sentiment, so your technical analysis has to then catch up. It isn't the same market conditions that you were building your previous pictures on. So I guess when the economy is stable, what we're trying to figure out is keeping inflation in check. We've got the growth, and before all this credit crunch stuff happened, it was all about listening to people like Ben Bernanke in the US and Jean-Claude Trichet in the European Union, and it was all about price stability. We had the growth, people were happy, people had jobs, so it's keeping inflation under wraps. Now inflation comes back to CPI, PPI, interest rates, housing stats, mortgage approvals. It's the same people that say the growth data. There are only certain people, that can control all fiscal policy, and growth and inflation go hand in hand. They control the same thing. But when we're looking, as we are now, to try and get away from this this need for excessive growth and just get back to normality, which hopefully will come at some point, then what we're figuring out is we're not looking at growth so much anymore. We're looking at inflation. Now, most inflation targets are around 2%. But with the sharp drop in oil, with wage stagnation, with this, that, and the other, can we really say what inflation should be? So very difficult to look at inflation data and make an informed decision. So really, again, that's going back to when you see these gaps in the market. It's not just about identifying the growth or inflationary cycle. It's understanding where we are and what the market is actually, moving based upon. And it will be some combination between growth and inflation, and the inflation will become more and more important. But until we get interest rates to a normal-ish type level, and we do see consistent hikes, it's still very difficult to know if the market is moving based upon growth or inflation data. So the inflation gaps, now this comes as the Bank of England, the Fed, and Mario Draghi discuss interest rates. Now, you'd have to live under a rock to know that basically, interest rates have been historically low for a long time. And we all know from history, if you look back to the 80s in the UK, interest rates, upwards of 14%. So nothing to say they won't ever go back to that, but it might take a different amount of time. It might take a different set of circumstances. Again, the 80s is only 30 odd years ago. What's to say what's going to happen in another 30 years? What is quite clear is nobody really knows, do they? Nobody really knows what's going to happen with interest rates. Nobody really knows what's going to happen in the future, and it's becoming less and less likely that anybody does. I mean, we've done all these very extreme measures like quantitative easing and historically low interest rates. We talked about helicopter drops, asset purchase facilities, etc., etc. But nobody can tell you what's going to happen in 6 months, let alone 6 years. So again, this is the whole point, that when nobody knows and this uncertainty is within the markets, the more likely we are to see a gap in data because people simply don't know whether to buy or sell. So the inflation kind of gaps you're going to see a little bit more in bonds and FX. So when we talk about bonds, talk about the UK gilt, German bond, US T-note, and again currencies. Think about interest rates in America, in the European Union, in the UK. What are they going to affect? Well, obviously native currencies. I think the biggest move we're really focused on right now is that one in the pound dollar, in cable, and that is all to do with Brexit. If it's good that we stay in the European Union? Is it bad we stay in the European Union? What is best for the UK? And what we're seeing is people voting with their feet. So the moves in the pound are based upon this opinion: if we'll be better or worse off if we leave the European Union. And that's what we can see. So if we see any gaps in the pound to the high side or to the low side, that can be an indication of continuation in a trend. Now the pound steadily sold off against the dollar for the last probably 18 months, but if interest rates in the US continue to kind of move less aggressively and the UK talks about putting interest rates up, people will demand the pound. If we stay in the European Union, people will once again demand the pound because, do you see much safety in the renminbi, much safety in the Japanese yen, much safety in the Aussie dollar? I mean, where realistically are you going to put your money? So if we stay in the European Union, surely that has to be a good thing for the pound. But then we don't want a too big a pound because, again, if the pound becomes much more expensive than other currencies, it hurts exports. So it's all a massive balancing act. So again, economic cycles are what we're trying to figure out. The gap in the pound dollar, it came from a comment. So this again, it shows you just how markets can change. So a comment from Mark Carney about interest rates happens, the market spikes down, but then it closes that gap, and then actually moves higher. To then completely go back to this level of support resistance that we've drawn in here, and then goes on to make a new high. So what does that really tell you? Well, very little. What we've seen is a gap in the market due to comments, then the market's discounted that gap and completely closed it. Okay, it doesn't mean the market won't come back down eventually, but that's again identifying the kind of gap that we've seen. So gaps like this, where the market was moving down, and then moves down very aggressively for a gap, but then it's quickly discounted. Well, the quicker it's discounted, the less likely that news was right or was important or is what people are making decisions on. So again, the quicker a gap is closed, the quicker it's discounted out the market. It doesn't necessarily mean that will have a factor on the rest of the trend or the rest of the market, does it? That's the whole point. So what you're looking for is the gap, how it forms. Does it continue? Does it reverse? What does it do? Okay, so in this instance, the gap was formed, it was very quickly closed, and then the market really didn't know what to do. Okay, it went a little bit higher, but then went lower, and then went higher. So in all reality, 1, 2, 3, 4 hours after this gap was formed, the market had completely discounted it, and the market was back trading where it was. Okay, so that is a piece of news that the market was not particularly interested in, and then closed that gap very quickly, and then the market didn't continue. It didn't continue in the downward direction. It didn't do anything really. It just closed the gap and continued to trade how it wanted to. So that really is an insignificant gap. Okay, so that's something we look at, we discount it, we move on. It was there, if we missed it, or we got on the back of it for a small trade, great. But the market moved up, it moved down, and the gap was closed. So the quicker a gap... Sorry guys, a few people are saying that we can't hear. So we've got Sheng, Pepe, Alan, and Ross. Okay, I can see all you guys are actually on mobile devices. Unfortunately, that's something to do with Omnovia. We can't control that. The connection is, Pierre, you're not on a mobile device. I can see who's on a mobile device here, and unfortunately, anybody who's on a mobile device, we do get this slight delay or slight gapping in delivery, and that's something we can't control. Unfortunately, that's an Nobia thing. So yes, sorry guys, if you're hearing it break out, then again, it is always advisable to watch these webinars via your laptop or your PC. But yeah, sorry about that. So again, all these inflation gaps, all these growth gaps, any kind of movement in the data, it can all be traded technically as well. So if you look at it from this perspective, the market moves down very quickly, and where's that 50%? Well, actually, 50%'s here. So as I said to you, 80% of the time, a strong directional move, if it gets back to that 50%, then that means something. If it gets back to the 50% fairly quickly, then the market actually from that spikes up and closes the gap. So again, it's another pivot point to look at. The gap, if it remains in the market and it trades around that 50%, so the gap's just from here to here. That 50% is a natural pivot for the market trying to decide if that data is going to continue or reverse. So in this point, the market reverses back to it, actually closes it, but then moves lower. So it's very, very difficult, isn't it? It's actually, very, very difficult because it kind of, when it works perfectly. When it doesn't work, it's so kind of convoluted. So what you've got to kind of figure out is, why is that gap there in the first place? How am I trading it? Am I trading that gap purely on the reason that something's coming to the market, it was unexpected, it's moved the market in a particular direction? Is it going to continue to move it in the direction of the gap, or is the gap going to close? And in this instance, the gap gets back to the 50% and then closes, okay, and then doesn't really continue in the gap direction. So the quicker the gap closes, that tells you one thing. The quicker the gap gets back to 50% tells you another. And if that gap does or doesn't close, that's the main point. If it closes quickly, gets to 50% and then closes, then it's been discounted. That gap really wasn't that important. If the gap remains and partially closes, then continues in that gap direction, then it's obviously something much more important. So, I mean, again, what we're always looking for is that whole point, why the gap was there in the first place. It's some news that's coming to the market that's made traders get out of positions and people get into positions. So when that gap partially closes or actually fully closes, the less amount of time it does to partially close or close, that means the more discounted that news is, the more the market is listened to what it's been said, and the more it doesn't agree with the gap. That's how you're looking at it. The market doesn't agree with the gap, the quicker that it closes. And I guess that's pretty obvious, I guess. Now, there are different reasons that we see gaps. Now, fundamental gaps, Graham's just saying, did you draw the Fibonacci from the bottom to the top? Yes, I mean, Fibonacci is basically, looking at the past to predict the future. So what you've got in a gap, you have the high and low of the gap, and that's where you draw your Fibonacci from. So it doesn't matter top to bottom, bottom or top, but what you're looking for is set points in history. A gap has had a low, and then on the downside had a high, so you draw it from that gap, okay? So obviously fundamental gaps are new news. So anything to do with inflation growth, as we talked about, anything to do with somebody from a position of power saying that something's changed. Now we get technical gaps for different reasons. Now technical gaps can occur for the reason that somebody fat-fingered, somebody presses a button by accident. So maybe they're trying to do 100 lots and they do 100,000 lot by accident. It happens more often than you might think. Then the large trade entries, if people are buying or selling lots and lots of lots at certain prices, that can cause a gap. Large trade exit, obviously, people are liquidating large positions. Then technical breaks, support and resistance. Now, you might see big levels, like big round levels in the FTSE, like say 7,000 for instance, or 2,000 in S&P, or 1,300 in gold. These levels sometimes, as they're being approached to, people put large amounts of orders through or pull large amounts of orders to confirm it. So if you see a technical gap, it generally happens around key levels, and it's much smaller than a fundamental gap. Because fundamental gaps are generally a lot bigger because they have much more impact. Whereas a technical type gap is just a movement of orders and momentum, so that the gaps are generally a lot smaller and they generally close a lot quicker, more frequently. So you can identify technical gaps or fundamental gaps very easily. A fundamental gap, if it's something big that hit the markets, it will generally put a gap or put movement into every market. So it's a terrorist attack in London, that will move the pound, it'll move the FTSE, the S&P, it'll move gold, it'll move bonds, it'll move everything. However, if you see gaps in one single market alone, okay, or one significant directional move in one market, if you see gaps in one single market alone, okay, or one significant directional move in one market, then that means it's generally just a technical gap. So if you see gold suddenly go 100 ticks and gap and nothing else moves, well, that's either a fat finger or a large trade entry or exit. So gaps generally technically almost immediately close, okay? And gaps generally will exactly appear between significant highs and lows, okay? Whereas gaps, when they're more fundamentally brought into the markets, the gap, in the middle of the chart. Whereas when you see a technical gap happen, it's much more time and level specific, and that's how you know it's a technical gap, because it's around an area of interest. It doesn't just happen randomly. It happens around a point where the markets have generally been thinking something significant could happen around this level. So again, technical gaps, this is how they look. So what we're looking at here is gold, and gold's a great example of technical gaps. The market gaps down here and reverses, but then we get to here and here, and we see two opposite gaps. So the market is looking like it should go lower by this initial gap, but it closes the gap very quickly and moves up. Then it gaps to the high side to get all the people that are short, because the market was moving down here. But then on the way down, okay, it quickly gaps down lower here, and then closes that gap, another gap, and then moves lower. So what you're seeing is the market, if you forget everything to the right of this blue line, the market's thinking, right, well, we're looking like the market's going to sell here. So we see a gap here, we see a gap here. So we think to ourselves, well, this is pretty bearish for gold. We see gold move down. But then gold gets everybody who's short into the market out by putting two gaps on the downside. Then we're quickly reversing. So gap on the upside to get everybody in. A big candle to get a short squeeze. And then it's like, right, okay, we are going to continue down here. So the market gaps down and then closes that gap, then moves lower. So what we're looking for really is a 120 tick short squeeze, okay? And it happens really to drag everybody who's short into the market originally. The gap is designed to get them in. The gap's then designed to get them out. So okay, this gap here is to get all the short-term speculators in. And once the market has reached the high point that it wants, the market then wants to get out of it quickly. So what does it do? Reverses this big green candle. It then gaps down to here to get people back into the market and sells it back down. So what you've seen is the market was moving down, and really in this area here, for no particular reason apart from a short squeeze and money making from central banks, hedge funds, whatever, they send the market of 120 ticks, and they use gaps to come in to get people in and to get people out, and then the market just continues doing whatever it wants. Okay, it continues to go up, down, further up, but all the money's been made in this area here, and it's triggered by a gap preemptively, gets everybody short into the market, then a gap to get them out, and then it uses the own gap principles to get their own profit out. So what you're seeing is essentially 120 tick short squeeze out of nothing in the markets. Okay, and only big banks and hedge funds can do that. So again, remember, we look at the technical gaps. They're always looking for the extremes of the market. They're trying to push out the short-term traders. Remember, the average trader has a 1 or 2% stop. So whatever their capital is, they'll generally put 1 or 2% of their capital as a stop. So if you're trading a £5,000 account, 1 or 2% isn't actually that much. So if gold spikes up 120 ticks and there's no news out, well, that's a technical squeeze, isn't it? Okay, so what we're looking at here really is the RSI spikes out of nothing. The RSI is going down, so we see a spike in the RSI really off nothing. There's no news out, and that coincides with what the market's looking to do. It's looking to get everybody in this down channel out. It breaks the upper channel. It gets everybody who's short out of the market, gets all the short-term traders into the market, then uses this gap to bring the RSI back down and then to squeeze the market back down. So again, the little nuances, the little gaps that appear in the market are not just there for show. They're there to show rejection, momentum, and reversal. And they're smaller. That's how you know it's a technical gap, because they're small. Very much like the fundamental gap that we saw back in that in that cable chart. It was huge. It was a huge gap. These are tiny little gaps, brought in by algorithms, computers, large volume trading to get people out of positions. So that's how you can tell a technical gap rather than fundamental. So what we're trying to figure out is, we've got a downtrend, we've got the RSI, we've got the moving average, all these different things, but a 9-tick gap is what's really triggering these things off. We've got people drawn into the market here as the RSI, as the market was moving down. So people in this downtrend are thinking, well, a gap downwards, that's got to be a good sign to short gold. It's going to go down to some key technical levels. Then the market, again, spikes up out of nowhere based upon nothing, gaps up and down just to squeeze people out. And the market does actually then go on to recover and make some new highs. So you can say it's coincidence, you can say it's what gold wanted to do anyway, but it's the fact that these small gaps, and they're all the same size in the market, really scream out that somebody's trying to move this market in a technical manner. It's not news that's moving the market back up. It's technical trading, large orders, lots of volume, people coming in to force that price action to change. So what you can look at is different time frames. So again, if you're looking at the smaller time frames versus the larger time frames, it looks different. So on a small chart, like a minute chart or 5 minute, the gap actually looks quite big. When you see that gap on the bigger time frame chart, it's actually quite small. So again, different time frames will give you a different view. And remember, they're generally at the extremes of the market. They're designed to get existing positions out, and they only last for a small period of time. So it's great to identify them in the small charts. But then when you see them on the bigger time frame charts, you know, your hourly, daily, weekly, monthly, they generally appear fairly small. All right, guys, any thoughts or questions? I mean, that is all about gap trading. So gap trading falls into two categories. The fundamental gaps, which are big, you know, in size, caused by news, caused by a real shift in what people are thinking. Your technical gaps, which are smaller, appear much more frequently in the lower time frame charts, and kind of you see them, and then they're kind of almost immediately discounted. But they can be used as a, you know, as a trigger to see how the market might change in direction. So again, these are all tools used by hedge fund managers, by you know, big traders, by central banks, you know, to kind of distort the picture that you're seeing. At the end of the day, you have to identify why a gap is in existence, what you think about it, and the gap's going to do one or two things. It's either going to go partially close, completely close, or reverse. So one of three things, should I say. But essentially, when you see a gap in the market, you know, big gap will be fundamental, small gap will be technical, and it's down to you what you see, how that moves the markets. Okay, Pepe's saying, who puts the pivot lines on the charts? Well, again, these are down to you, isn't it? And again, you know, do you draw the Fibonacci? But we've already answered Graham's question about the Fibonacci. But the pivot lines and support and resistance lines, you know, they're your lines. You know, that's where you put them on the charts. Anybody can draw support and resistance, pivot lines, you know, trend channels, whatever you want to put on the charts. That's down to you. But again, it's your understanding of the charts, and you have to, when you see a gap, try and put the technical information around it to give you a better picture. Good question, Graham. I'd say it's best to set up Fibonacci on a higher time frame. So I'd say generally an hour. An hour is good. You're looking for a significant directional move, so a significant low to high, high to low, or a significant candle. You know, maybe, you know, a big 1 hourly candle is something to indicate something's happening in the market. So generally, yeah, you're right. Hour and above is probably best, Graham. No, Matthew, absolutely my pleasure. Don't worry. I mean, it's that's what I do. You know, I present these webinars, I present them live, so you guys always get a fresh perspective and different insights, and you can also ask me questions. That's what I'm here to do, guys. All right, guys. Well, listen, anything else, get me on the emails that you see, or you can get me on Twitter at Steve Ruffley. Again, if you want to look at iView charts, I'm running some offers where I can help you, you know, set up these charts and set up, you know, an idea of your technical analysis. So, you know, go to iviewcharts.com or just Google my name, Steve Ruffley, and you'll find out, you know, what I'm all about. But anyway, guys, it's been a pleasure as always. Hope you've found it informative and interesting, and I will speak to you all very soon. All right, guys. Thanks very much. Good night.